Hey everybody, thanks for joining us from that short, quick little break. So I wanted to jump into our real estate roundup this week with one word, recession. And is it inevitable that we're going into a recession? Are we already in it? I think it's just a term that you hear about a lot right now, especially, and have probably for the last couple of weeks based on inflation, based on interest rates. But let's loop that back into the housing market. And does the recession mean a housing crisis? So something that I've come across recently that I think is a fun piece of, just a fun fact for everybody, is that out of the last 6 recessions we've experienced, in 4 of them, homes have continued to appreciate, and in only 2 of them, they actually depreciated. The 2 times they depreciated, once in the early 90s is less than 2%, is minimal. And then the one that everybody remembers is the mid-2000s. With that being said, I think it is realistic and fair to say the housing industry did cause that recession, or a lot of it. And unfortunately, it did have a lot to do with the lending practices that are no longer allowed and in place in any shape, way, or form. So again, it's just totally different with that being said. And I think it's fair to say the mid-2000s is an outlier, not the standard. Oh, yeah. And I think, unfortunately, too many people look at it as a standard to say, oh, we're here again because we saw it in the mid-2000s. Guys, that was the only time in our history that we depreciated that much in housing. Again, it is not a cyclical thing that happens every 20 years, every 10 years. It's just not reality. That's not an opinion based on facts, if that is where your head is at. So what is based on facts is, again, 4 out of our 6 recessions that we've had most recently, homes continue to appreciate. Jay, with that being said, what are your immediate thoughts when you hear recession and what that means to our housing industry?
Yeah, well, the easiest one and the quickest one, just to dispel all those myths, is currently the housing market is based purely on basic economics. So if for those of you that did sleep through economics class, supply and demand, when there's lower supply, but still high demand, prices rise. And that's what's happening. It's not a overpricing of the market. It's not an underpricing of the market. It's not, any outside factors that are making this inflate, or the prices of housing or rent inflate for arbitrary reasons. It is actually because there is just a higher demand and not enough supply to go around. You have to look at, so millennials were the largest generation, the largest amount of people that became home buyers in the last few years. And then who also is joining? Well, Gen Z is also just graduating high school now. They're coming into the workforce. They're making good money. A lot of them are deciding to not go to university, but instead doing a trade or advancing career-wise without that 4-year degree. So they're jumping into the housing market even sooner than previous generations, especially the millennials. But when you have 2 generations that are 2 of the largest generations in U.S. history, now jumping in and wanting to start buying houses, you're going to have a supply problem, especially with the last few years and home builders not able to basically get materials to build houses to keep up with this. And then something that we'll be talking about probably next week, so be sure to follow, corporations and investors during all these kind of crappier times in the past decade, especially after 2008, bought up a lot of the housing inventory and are still using those as short and long-term rentals. So these are the big things that are affecting the housing market. And if you notice, none of it was me saying houses are just overinflated. That wasn't a reason.
Here's an interesting thing on what fair market value is, because I think some people say, well, you overpaid for that. Well, hold on. In my opinion, fair market value is determined by a buyer based on what their options are. Simple as that. And fair market value for a seller and what they'll sell for is based on what their options are and what their competition is. Like, that's fair market value in a nutshell. So for you to tell me I overpaid for my house, well, let me ask you, for whatever nice thing you have, did you overpay for that? If you have a Rolex watch and I like my Apple Watch, I would tell you, you paid too much for your watch. You got ripped off, right?
Yeah.
For a car, if I like my beat down Ford and you like to have the newest Chevy, whatever, Toyota, whatever, Tesla, whatever, in my opinion, I would say you got ripped off. You paid way too much for that, right? So I think people lose context of cost real quick and jump straight to you overpaid for that. I think something else that stuck with me recently that I agree 100% with is what's not a deal today is a deal in 10 years.
Yeah.
Name one house that someone overpaid 10 years ago that is still hasn't caught up to its worth. You won't find it. Like, funny little fact for everybody out there is, oh, you got ripped off. Hang on for it for 10 years and tell me that you still got ripped off.
Yeah.
You're going to say, so I should have paid that price 10 years ago.
Let's jump into why this is important for the recession. So basically what we're getting at is whether you buy now or you think that there's going to be a bubble that's just going to pop and now home prices are low and you think you've lost all this equity. Well, first and foremost, just like in the stock market, say prices dip or level out, right? Say worst case scenario, you lose 10% or 50. Let's even go back to 2008. You lose 50% of your home's value.
No, it's 20%.
20% on average. There you go.
Yeah.
You haven't lost anything until you sell it.
Yep.
If you're now saying, oh shoot, I need to sell because my house's value went down, that the lending practices aren't the same. You don't have to pay back the loan right away unless you went with something that's not a government-backed loan or that Fannie Mae or Freddie Mac aren't buying on the secondary market. Basically, you circumvented all of the safety precautions and procedures that were put in place because of 2008. If you went around those and went to a hard money lender or something like that to buy your house, 100%, you should be worried and you should want to refinance right now before anything happens. But worst case scenario, you haven't lost actually any value in your home because you bought it at the proper time, unless you sell it. That's the only time. Same with stocks. When people, it gets very annoying when people say, oh, I lost money during the stock market, or the stock market's unreliable. I lost so much money on it. Stock markets don't lose you money. Like, they might have a dip, but until you sell it, you haven't lost anything. You can ride out the storm. And that's stocks, just like a house, is a long-term investment. So if at every dip you're like, time to sell, then yeah, you are losing money in both real estate and the stock market because of yourself, not because of the market itself, but because of your own actions. So let's clarify that. You're not a victim of the market. But yeah, view your house as a long-term investment. And if you do that, then small little dips, like any recession that we have every few years, all of a sudden aren't that scary because you know you're not going to sell during the dip and you're just going to gain all the equity back and plus some, as historically has been the rule, just by holding on to your house.
Yeah.
So
here's another angle, a more specific angle to think of when it comes to the recession is those that haven't got a house yet, right? Those that want to get a house. Interest rates, again, ticking up, that plays into a recession. It starts to slow the market down naturally. I think the silver lining of interest rates rising is it slows down home appreciation, which for prospective buyers is a positive, right? Because now things aren't accelerating as fast. So I think that's a reality to be mindful of for prospective home buyers out there. Again, does rising interest rates negatively affect your buying power? Unfortunately, yes. What else does it do on the positive, though? It slows down that home appreciation that was unsustainable. So that's the Fed's way of trying to help out the rate at which houses are continuing to accelerate is by ticking up those interest rates. So something to be mindful of. And again, a silver lining of sorts. Inflation. I think that's unfortunately a big player that is naturally going to take some people out of the market that haven't got that home yet. Based on the fact that gas prices being what they are, like, it's starting to wear on people, right? 2 months in, 3 months in. The unknown how much longer am I going to have to pay X amount of dollars per gallon? Like, I think those are understandably parts of a recession that come with a recession, is the cost of goods going up, and now your cost of living goes up, and now you have to make decisions. I can't afford that same down payment. I can't afford that same monthly payment if I'm going to pay here in California $6.50 a gallon for gas or a gallon of gas.
Yeah.
Right? I think those are important players to consider, to rethink, does this make sense right now? If I'm not currently in a house, am I able to afford it? Because where people do have that buyer's remorse is they don't think a little bit long term before they get into something. They just get straight into it. And then they have that buyer's remorse because there's like, this is unsustainable. I can't do this. So
yeah,
things to be mindful of. And it's a multiplayer environment that we're in. I think people like to isolate things too often and just say, well, that doesn't make sense, so nothing works. Or that's moving and that's in a good direction, so it doesn't matter, right? That they look at one piece. Jalen, thoughts of hearing that?
Yeah, definitely thinking on just the one piece and not having that long-term mindset. So the final thing that I want to touch on is on that. So we've talked about long-term mindset a few times, and not just focusing on the now, and especially with interest rates. So understand that when a recession hits, the Fed is wanting to help basically rejuvenate, and so help with buying power and all that kind of stuff. So naturally, in the mortgage world, interest rates go down, and that spurs more people into buying. So anyone that is hesitant on buying now because they're afraid of that monthly payment, still is probably worth it, is what I'm going to say, because even though you get that worse interest rate right now, interest rates are going to be on the rebound like they have for every single, even minor recession. And so you can refinance 6 months after you buy your house and get that monthly payment that you wanted at the house price that you're comfortable paying for. So don't let the current interest rates scare you. And also, just one quick piece of advice: don't buy down your rate. Don't pay for a lower rate. A lot of companies are going to show that, especially when there's these really high interest rates. They're going to show how great a lower interest rate is going to look. And you might think that it's worth it to buy that interest rate down. If you're going to get that same interest rate in 6 months without having to pay any money versus paying a couple $1,000s or however much you end up paying to get that lower interest rate, you're not going to break even. You're saving, you're spending money to get a lower monthly payment. So hold off, buy your home now without paying for a lower interest rate. Wait for rates to dip down, which they will if we hit that recession / when we do, and then get that better interest rate. So just a quick tip on why you shouldn't be paying money for a lower rate.
Yeah, and again, prospective home buyers out there that haven't gotten that home yet, just remember you can accept it on your monthly payment and your credit, not on your interest rate, right? So again, what is that monthly payment? Is it doable? Is it a little bit higher than you wanted, but still affordable? Again, you have to make these individual decisions, but just be mindful of that. Don't let an interest rate, as Jalen alluded to, don't let that scare you off. Again, if your monthly payment is still a manageable amount, he just gave you the answers. You can refinance in the future. And again, you've already made that decision to say, yeah, that's higher than I wanted to pay, but I can still manage that long term, right? And that's still doable. What do you have on the back end of that? You have appreciation that's been keeping you out for so long, right? Now working in your favor. So things to be mindful of. Here's how I'll wrap this one up. And that is, for those of you that get knocked out because of interest rates, because of recession, because of cost of living, talk with a financial advisor. That is not Jalen or I. Mm-hmm. And I think those are important players. Again, it's free to talk to them to get their opinion on something and figure out if you do have to press pause in your home search due to cost of living expenses. They can help you invest your money in a space that is going to accelerate and be stimulated versus just put it underneath your mattress and it not grow at all. It might grow because you say, well, Nick, I can save $500 a month. Yeah, but how can you use interest to play in your favor? And that's where I think those financial advisors can come into play for those individuals that get knocked out of this market right now. Talk to them because they can help you make money work for you. and be able to use compound interest in your favor. So something to be mindful of as you're navigating your individual situations.
Definitely. Well, yeah, as Nick said, that was his last point. I put in my 2 cents. So hope you guys got some value in this one and aren't too afraid by all the scary news headlines. If you have any questions, please feel free to reach out to us, but we're going to take a quick break and then we're going to jump right into today's business bookend, which is 7 habits of highly effective people. So we'll see you back here in a few seconds.